Hi, this is Michael O'Leary again from By the Book Taxes, here with our latest video blog on one of my favorite topics called Offer and Compromise. Today we're going to talk about the different payment options you have when filing an offer. Just to take a step back, the Offer and Compromise program allows a taxpayer to settle back tax debts for less than the full amount owed because the taxpayer does not have the assets and income that will allow them to pay the tax in full. Once again, 3 reasons to file an offer and compromise. Doubt as to collectability. The taxpayer just doesn't have the income or assets necessary to pay the full amount owed. Doubt as to liability. Does the taxpayer really owe what the IRS says they do? Typically, there's some sort of dispute here. And the last and the rarest is effective tax administration, where, given the taxpayer's facts and circumstances, it would create a real hardship in the taxpayer's life, most likely due to age and medical situation, to attempt to collect the debt in full. This is the second part of the video on the subject of doubt as to collectability. That's really what we're focusing on. The next 2 slides are going to seem redundant from the last presentation. The reason I have them in here, it is so important to understand the financial analysis that must be done before submitting an offer. 60% of all offers are rejected. That is because even many tax professionals do not know how to correctly do the financial analysis and correctly fill out the forms. And certainly taxpayers don't. They watch these TV commercials where they're told that they can settle their debts for pennies on the dollar, and they have no idea how the program actually works. One variable that is critical to this is knowing how long the IRS has to legally still collect the debt. It is 10 years or 120 months from what's called assessment, which is typically when the taxpayer files a return. So the question is, upon doing the financial analysis, is the result that you come up with prove that the taxpayer has more assets, more income than the tax debt owed, or less? If it's more, the IRS will not compromise. If it's less, they may. Okay. This financial analysis results in something called reasonable collection potential. That's what the IRS calls it. There's 2 pieces to reasonable collection potential. It is, number 1, a taxpayer's net equity and assets. If they liquidated their assets in a fire sale, which is basically 80% of the value, paid off the loans and mortgages against those assets, how much money is left? Then you look at the taxpayer's monthly income and expenses. Take the gross income, subtract from it a concept called allowable living expenses. Not everything they spend money on, multiple cars, multiple vacation homes, private school educations, etc., but rather a concept called allowable living expenses based upon national, local, and regional statistics put out by the Department of labor, cost of living statistics, basically. So that net number, gross income minus the allowable living expenses, equals the monthly future income. Take that future income, multiply it by the number of months you have left on the collection statute, and add it to your net equity in assets. And that's the figure you come up with. Is that figure greater than the debt? Then you can't compromise. If it's less than the debt, you can. You have two different payment scenarios here. You can give the IRS, you can make them a lump sum offer. For example, let's say your analysis comes out that all you can afford to pay the IRS is $10,000. Maybe you owe them 50. You make them an offer of 10. You have to put 20% of that 10 down, that 10,000 down, or 2,000 down. If you make a lump sum offer, that deposit has to be made upon filing the offer, and in a separate check, you pay the $186 filing fee. If the offer is accepted, you must pay the balance, that other $8,000, within 5 months of the acceptance date. You also could pay them off on a longer term, up to 24 months. You still have to pay the $186 fee. There is no down payment required, but you must start making monthly payments equal to 1/24 of the offer amount while the offer is being considered. So if the offer you're making is $10,000, you would have to make a monthly payment to them of a little over $400 per month while the offer is being accepted. Considered. Upon acceptance, you then would have to pay the balance in no less than 6 months and no more than 24 months. So two different methods, short term, longer term, same financial analysis. The only difference with the deferred offer is that they look at 24 months of income, whereas with the lump sum offer, they look at 12 months of future income. If you have years of unfiled tax returns, or you owe the IRS a lot of money and they're sending you scary certified letters, please call me. I can help.